let's take a look at it. So first of all, this is our primary setup. We've got the far left chart. This is our longer Renko chart. If we are above the demand zones are green, supply zones are red. If you're above they're buying liquidity. If they're below, they're selling liquidity, meaning we're in a downtrend, green uptrend. Very simple. So what you want to see then is you want to match it up, and you want to match up if we are green to the upside, meaning they are going to these demand zones and they're above them. Then we want to see these type of trades where we match up. Right now we're green red or opposite trend filter. You want to see trades that happen like this. Here at 6:30 this morning. Here is your, there's your V bottom, and then your first liquidity grab occurred right after that V bottom. First liquidity grab, it did the failure trade first, and there's your first liquidity grab for a run. Now I got a 350 stop, and I got a 350 hard target on the strategy. We went over that in yesterday's video. You can, what you can do on the strategy is you can put per trade what you're doing with the profit target. Profit target is a 350. Stop loss is 350. So it will go based upon not your stop and your ticks per se, which you can still do ticks. Let's say if you're going for 350 and you're doing a couple contracts, you can scale some off at 4 to 8 ticks as it's trying to get to the 350. And it will do that. And you can even put break even on that also if you wanted to. But if you just want to use the profit target and stop loss by itself, you can use that with just a specific dollar amount per trade, 350, stop loss 350. That's what I have in there. So, but what you want to do, you can see if we're green, it'll take the first liquidity grab. That's what we want to see. We want to see if we can get into this first liquidity grab like this for the possible runs. The opposite would be here would be if we're in a downtrend. You want to see that if you're in a downtrend, you want to see a V top for a liquidity grab short. Okay, so once you're in a trade, let's say a trade setup, and you're in, and when you match up green, red, then you can look for a liquidity grab, buy or sell. Like right now, we're not matching up, or red, green, so this is still into a, it goes upon a specific zone. But if you want to turn liquidity grab trader on and let it trade when it's red, green, then you're matching up with your overall hard trend. And you'll get those hard trends like yesterday. You see a lot of those hard trends that happened yesterday to the upside and downside based upon when you match up. So your stop will come in. Get this out of the way. There you go. Your stop level, if it does take a short side setup, your stop and profit targets will come up as red, or red is your stop, green is your profit target, 350 stop, 350 profit target. It's going against the big trend right now. So you don't have to turn on liquidity grab trader until we turn green. You can turn it on and let it run as much as possible since this is a smaller time frame. So these smaller Renko sizes like this, if you trade a 120, 125, 30, or 35, you want to match it up green, red. Right now, we just don't have that type of market yet. Once it turns green, you can simply click it on and get ready for the setup after it turns that color. So, you just simply take a click of the mouse, and then it will be, it'll turn on for you as far as that goes. Off, I'm sorry. And then you just simply click it on when you get that match up, and then we'll get into the first liquidity grab trades. What I want to show you this morning, we went over this yesterday in yesterday's video, several trades like this. So what I want to go over this morning is I want to go over how to cherry pick the best liquidity grabs. So play yesterday's video. I go over this in great detail on how to do this, how to go with the overall big trend, and then getting into the liquidity grabs. What I want to show you I can set up is this chart right here. You can set up where what is the best when they're trying to buy liquidity. I'll mark some up yesterday for you. When we're trying to buy or sell liquidity, where's the institutional grabs at? Where can you possibly see a big institutional grab where this market could run 10, 15, 20 points and so on like this? And I'm going to show you what we had like eight of them yesterday or so. I'm going to show you how to get a directional move. How can I cherry pick this V top and the first liquidity grab for a big potential move? 13 all the way down to 83. That's a 38-point S&P point move. What we have is we have these demand and supply lines, zones that are on the chart. So that's on this chart over here. You can see that here's the demand zone, 88 to 84, 88 to 84 here. Here's your demand zones. Okay, so when you get into a demand zone or supply zone, if price reverses inside of that zone, meaning if you get into it and it doesn't exceed it, it can come up to it and touch right on it, or it can come up to it and touch right on the outside, just so it doesn't break or violate that zone. If that comes up like that, if that does happen like that, then you have a possible big liquidity grab. So this is a demand zone, which I'll show you how to put in your charts. And this is the supply zone. So you can see it over here on this trade right here, our 30-year back tested zone. That's why I came up with the trade. It'll always go in the trade of the 30-year back tested zone, but it's got a demand zone right below it. That's why the trade's not really falling really hard yet, because you got red green, right? You're into a chop market right now. So what you could do is you could set your chart up and you could find the optimal spot where the market's going to run by looking where these demand zone and supply zones are going to get into. So right now the market's into that demand zone. That's why this short, it's not agreeing. It's green red, right? It's in a chop market right now, so it's popping out of the demand. So if price gets into this zone, and I'm going to show you guys how to set this up right after I get off this video, but I'll show you the settings for this. Once you get into this zone, price gets into it, and it doesn't close outside the zone, and you get a V top when it's red in the supply, that is a critical level for a possible big move in the market. Consequently, if I get into the green zone here, green zone, and I don't close outside of it, and I get a big V bottom reversal, that market could run within 10 to 15 minutes, a big, like I said, 5, 10, 15, 20, 30-point run. This was a 30-point run on this. I'll show you several examples where this happened yesterday. So you can literally just have this chart sitting there and watching for a zone for you guys to see where the possible V top or V bottom is going to occur. And then you can see if the zone's going to hold. So when you're doing these type of zones and they come down to it, so this is a demand zone. We had a big rally. So you see how we come into the demand zone. This is a very leading indicator. You come into it, come into demand zone. We don't close outside of it you can't even close one close outside of it. It's got to come into the demand zone, and it's got to give us a V bottom. There's your V bottom. And then it proceeds to go from 54.04 to the swing high of 35. Ran another 30 S&P points in a matter of 15 minutes, 30-point move. Because it's getting into this demand zone. This is the deep liquidity grab. So I have red supply and green demand. And what this does, it calculates all day long where the high probability demand, the deep liquidity grabs are in the market, where they like to bring the market down or bring the market up, and they like to V bottom or V top it. So you can go and see, this is supply, this is a supply, this is demand, doesn't stop through it. You want to see where the V top occurs. And so it can't be green. If you're selling, it's got to be red, and green's got to be buy. So you want to see where they're going to stop. There's a small one that happened there. You want to see where the demand, now it can come to the edge of it and then it can pull in, but these are very big possible moves that are V bottoms, V tops. Now, you can see that at 1:30 yesterday, it came to the demand zone. It got into what, 16, rallied up to 36, moved 20 S&P points. These are very, very, very important levels that you can see on a daily basis on any market. This works well in the NASDAQ too, on any other market. When you come down, these supply and demand zones, here's a big demand zone, green, red, right? So you want to look to buy. It gets in the demand zone. There's your V bottom. The market proceeds to go from 15 up to 41. So, that's 20 S&P points in a matter of what? Not even, this one was about 20 minutes. So when you see price reverse out of these demand and supply zones with a V bottom, V top, if you're green zone, you want to reverse in the green zone. If it's red zone, it needs to reverse in the red zone. It needs the V top or V bottom inside of it or right at it. Here's another one, V bottom right inside of a demand. It can't exceed it. It's got to come down to it, get a reversal, 11 all the way up to 32. Another 20-point run in the S&P, and it happened in under 10 minutes on that big run. So this happens all day long on these markets. Supply zone works the same way. Supply zone. So the light red is the shallow supply zone. The dark red is the deeper supply zone. But you can tell we reverse inside of the zone. The market proceeds to move 13.5. It just stair-stepped down, and it got crushed in a matter of 15 minutes down to 85 from 13. So once again, it fell 25 S&P points. When you get to these zones, they like to react off of it. Here's a beautiful supply zone short. This happened at 11 o'clock yesterday. So here's a smaller one. Then the big one came. This big one really shot down pretty hard. 33.75 down to 01, fell 34 S&P points. So here's one. Now it can touch the edge of the zone. That's fine. So as long as V tops, what you're doing is you're waiting until the market retraces into a big, deep liquidity grab, even on these smaller charts. You're waiting if it can touch right on the edge and gets a V top. This market proceeds to go. It gets pretty well hit down to 20 S&P points right away in about not even 10 minutes. Again, right at the top of the zone. You got to get in the zone or top the zone. Red to short, green to buy. You can have this indicator on the side so you can see it. Here's another big sell zone. It comes right up to it, doesn't exceed it. You can see which ones are going to be the possible big ones because you won't exceed the supply zone or demand zone, meaning here's demand, green, here's supply, red. You come up to it, there's your red supply zone, and then it proceeds to fall from 71. I mean, it just got smacked pretty hard. In 10 minutes, it was already down from 50, from 71, 20 S&P points, and it proceeded down 40 S&P points. So this is where what you don't want. You don't want to see it exceed the zone. I want to stay right inside that zone so we can have precision trading. And then if you get that zone right there, if it reverses, then you get a possible big reversal in your hands. It can be right at the edge of it. Here's a small one at 1043. It can be right at the edge of it. It just cannot break below it. This is not set up, and you don't sell against green. This broke above it, so it doesn't qualify. So you can see exactly which ones qualify when you do it. So you need to come up to it, get inside the zone. Here's another good one that happened at 10 o'clock. You want to come up to the zone, get a reversal, and then look for that push. This is 82 down to 62, another 20 S&P point move. Now this was right at 10 o'clock, so the market's fast. Let's go to a slower market. When they come into these zones, here's 9:38 time of day trade. Once again, It comes right up to that zone. You get that big reversal point, nice smack in the market. You go even earlier at 9 o'clock. We had a big one at 9 o'clock. Here's a big trade. This trade worked great. Went right down to the top of the green zone. Now, these are the ones when they do match up. If the shallow and the intermediate, the longer term demand or supply zones match up, this is a type of price action you usually get. It's relatively pretty fast. This moved from 48 down up to 96. It was a big, almost 50 S&P point move because they both matched up, came right to the edge of it and rallied really hard from that standpoint. But these are typically what you'll see. You'll come down to the demand zone. You get inside of it. You don't break it, either this demand zone or this demand zone. It's got to reverse on one of them. And then once it reverses, you get a nice little punch in the market from 43 as high as 61. And that was a matter of 15 minutes. You get a nice little 30-point potential move on the S&P. And then here's another one. You come down to the demand zone. This time it went to the lower zone. It got inside of it. This is the deepest zone there is. Got inside of it, never closed below it. That's a great V bottom to take. And that's 38 up to 57. Another nice little run in the market. So you can see which ones like to reverse. Here's another big one. You can see this is a beautiful V bottom right inside of the deeper demand zone because it's dark color. This one rallied from 5,400, ran 34 S&P points on that nice move up. So when you're looking at these, you want to look green, or you want to, if it's red, you want to see it reverse into the sell zone. And if it's green, you want to reverse into the buy zone. And so as this ticks along, I'm going to leave this chart up today for you guys just to watch, because I usually leave the 135 and the 125 up. I'm going to show you how these zones are so accurate. They like to reverse price. You can see here's my zone. That's why here's your last move up. It got into the demand zone. That's why they're pushing this market up. Right there's your demand. Right. Just remember, green is where the demand zone is, and red's where the supply zone is. So that started the push in the market at 94.25, and it's pushed all the way up to 07.5 already. So because it got down to this demand and supply zone. So I'm going to show you traders how to set that up on your own charts. I'm going to leave this up today for you guys. I'll leave this up. Let's put this over here for you. And I just want you to watch it. I'm going to show you how to set this up on your own charts. Watch how these levels reverse price. You're probably going to get, gosh, how many was yesterday? Let's see. You're going to get 5 to 10 of them during the day. We had a lot of them yesterday. 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13. Yeah, so we had well over 14, 15, 16, 17, 18. Yeah, so you had well over, you almost had 20 trades like that yesterday. So what you're doing is you're looking for the market. These, I call these institutional liquidity grabs, because for them to get to these lower zones, these green zones or red zones, and reverse inside of them, it tells you pinpoint accuracy where the possible run's going to happen. Just remember, green zones for buys, red zones for sells. So it needs to reverse inside the red zone for sells or green zone for buys. Don't make it any more difficult than that. Red zones for sells, green zones for buys. Okay, so make sure we're good. Now we're matching up. We're green with the overall push in the market. So, and also when you're adjusting, use the Symm tick liquidity grab trader, the Symm tick liquidity grab trader, not the Symm close, because the Symm tick, you can adjust stop. So in this trade right here, you can adjust your stop. Here's your target, 350 target, 350 stop. You can adjust that and so on. The other thing I want you to watch out when this happens, when these come down to these grabs like this, right? When you first get your V bottom, V top, watch for the first liquidity grab to propel price. So your entry on this trade was 95.25, and the first push it went up five points pretty immediately. You always want to look for the first liquidity grab on the push. So if you get into a demand zone and it holds, they held at 3 o'clock this morning, demand there. Look for the first liquidity grab after the push. So say that you're holding the supply up here. It got right inside of it. Look for first liquidity grab to get that going. Remember, your stop should be, okay, here's another thing. You don't have to use larger Renko sizes for this, by the way. So you can put this on any Renko size that you want. This is a 1/130, you do a 1/125, you do a 1/120. If you use a 1/120, you're just going to get more V tops or V bottoms inside of the zones. If you use a larger Renko size, let's say the 125, 130, 135, you just get one big V top, and then that should run the market like here. That started the run as far as this goes. So I call this a great way to look for big V bottom, V tops. And like I said, I can go all the way back for a couple of days. It doesn't matter what days you look at. It's the same thing. It's the same thing. You're looking for, here's one right here. I mean, this is just a beautiful trade. This is a couple of days ago. You get into the supply zone right here, supply zone. It reverses before it even, you won't even close one close outside of it. And you see these hits. I see it every day like this on a day-to-day basis. That is a 30-point potential S&P hit. And so you get into the demand zones the same way. Let me show you a demand zone buy. Demand zone. That just broke the edge of it. This got really close, but it did break the edge of it. So I don't take those. But if you would have stayed above in that small demand, the price really reacts hard off these demand and supply zones. So when you're doing this, like I said, just make sure that you understand the demand is the greens to buy, reds to sell on these demand supply zones. So I'm going to leave this up here today. This is the last buy, V bottom buy signal we got using, I call it the institutional supply and demand level, because it works well with our liquidity grab trader also on cherry picking which ones that could possibly have a nice little run in the market. All right, so I'm going to leave that guy up here, and then I'll mark these up as we progress through the day. We'll go over them again tomorrow, but I just want to leave this on here today to show you, when they adjust, how they adjust. Like if you look at the demand zone down here, it's the same. This demand is the same as our demand zone over here on our trend chart. If you look, all these red levels were the same, and all these green levels were the same. So right now, where the line in the sand is 84 and 88 is the demand zone to pop this out of the market, and that's what it just came out of. It just came out of that buy zone at this level. So this is indicator based. It's not strategy based. So you can just use this as an indicator to see where the market can propel itself out of. Now, if you want to, the NASDAQ futures works the same way. It doesn't matter what market that you look at. It's the same exact setup. Now, the NASDAQ can go a larger Renko size, but it's the same exact setup. You're trying to look for it to come to the demand zone or supply zone, and then fire off into that into the next V top or V bottom. All right, so just something for you guys to heads up on. It's a real neat way, for you guys to look for supply and demand as it works. So the trade we're looking for now, we're looking for a V bottom. So I'm skinny this down over here for you guys. All right, so we're going to look for a V bottom right now, V bottom with the overall trend direction, and we'll look for the first liquidity grab. We're green, looking for the first V bottom, and see if we can get a price to propel to the upside. All right,